So in this video, we are going to have a look at corporate income tax and the capital tax computations. So firstly then, we will focus on the corporate income tax side of things. So when calculating this, there is a standard pro forma that we can use. So all we do is take our accounting profit, deduct our income exempt from tax or that of which is taxed under other rules. We add back any disallowable expenses and accounting depreciation, and we then deduct our tax depreciation allowance. This will then give us our taxable trading profit figure. So looking at this in a little bit more detail then, what do we mean by accounting profit? So this is the profit before tax, which will be shown in the statement of profit or loss in the annual financial statements, and that is the figure that you are going to use. You then have to deduct income exempt from tax or taxed under other rules. So essentially, this is any income which is included in the accounting period, in the accounting profit, which does not relate to the main trading activity. So for example, this could range from dividend income to interest received and rental income, just to name a few examples. You then have to add back any disallowable expenses. So these are expenses that have been deducted from the accounting profit. They are allowable under accounting standards, but under the tax rules and regulations, we cannot claim them. So we need to add them back to our profit figure when calculating tax. So UK examples include client entertainment, political donations, and gift aid payments. We have to also add back any accounting depreciation. This is ultimately simply an accounting entry that is not allowed for tax purposes. It is too subjective. It is based on opinion. It's an estimate. So this will then be replaced with tax depreciation allowance. We then have to deduct tax depreciation allowance. So this may also be referred to as any capital allowances. And ultimately, all this does is replace your accounting depreciation. And it will only be given on certain items of capital expenditure. And more often than not, it will be given on a reducing balance basis as opposed to straight line. It will be given if the asset is owned at the accounting date. If the asset is not owned, then you cannot calculate a tax depreciation allowance. Balancing allowances and charges then. So when an asset is sold, any accounting profit or loss must be disallowed for tax purposes. It is merely an accounting entry. It will, however, be replaced by the tax equivalent, which is known as the balancing allowance or charge. So a balancing allowance is a tax loss on disposal, whilst a balancing charge is a tax profit on disposal. So the standard pro forma for this then is essentially very similar to the previous pro forma that you saw. So we take our accounting profit figure, we deduct any income exempt from tax or taxed under any other rules, whilst adding back our disallowable expenses, our accounting depreciation, and now also our accounting loss on disposal of an asset. We, however, will deduct accounting profit on disposal of an asset, as well as the tax depreciation allowance. We would then add back the tax profit on disposal of an asset, which will be our balancing charge. Contrary, we would deduct our tax loss on disposal of an asset, which will give us our balancing allowance. And this leaves us with our taxable trading profit. Disposals. So the accounting profit or loss on disposal for accounting purposes can be calculated using the following formula. So you just simply take your sale proceeds and deduct your carrying amount as seen in the statement of financial position, which will ultimately give you the accounting profit or loss figure. So if sale proceeds are greater than the carrying amount, that means you have a profit. On the other hand, if your proceeds are less than your carrying amount, you have ultimately made a loss. So looking at this in a little bit more detail then, accounting profit or loss will be treated as disallowable for tax purposes in all circumstances. Profit will be deducted from the accounting profit, whilst a loss is going to be added to the accounting profit. This will then be replaced by either a balancing charge or a balancing allowance for the purposes of tax. If your proceeds are greater than your TWDV figure, this will be a balancing charge. If the proceeds are less than the TWDV, this is going to be a balancing allowance. So ultimately, the calculation there is your sale proceeds less your tax written down value is going to give you either a balancing charge or a balancing allowance. Moving on then, the next thing we are going to look at is going to be trading losses. So if a trading loss is made in the assessment for the tax year, the tax will be nil. An entity has to claim loss relief on the rules of a country's tax regime, which may differ from country to country. There are, however, ways in which we can relieve a loss. So the first option we have is to carry a loss forward against any future profits, but they must be of the same trade. Secondly, we could carry loss backwards against previous periods. We could offset our losses against group company profits, or we may choose to offset losses against capital gains in the same financial accounting period. So what happens then if a business is going to cease and a trading loss occurs? So if an enterprise ceases to trade, most countries are going to allow the entity to carry back the loss against profits of previous years to generate a tax refund. In the UK, terminal loss relief and loss can be carried back up to 3 years under current tax rules. So the second part we're going to look at is going to be the capital taxes. So capital tax gains are going to be made on disposal of investments and other non-current assets. In order to calculate, again, we need to do our sale proceeds less our asset at cost value. So again, we have another standard pro forma for this. So we simply take our proceeds minus our costs to sell the asset, which gives us our net proceeds. And after that, we deduct our original cost of the asset, our costs incurred to the purchase of the asset, any enhancement costs we have made and paid to the asset, and any indexation allowances we also deduct. This will then result in us being given the chargeable gain figure. So what type of costs then can we deduct from our proceeds? Well, we can deduct the original purchase price of the asset. We can deduct any costs that we have incurred to actually buy the asset. So a good example is if you're buying a house, you are going to incur legal fees, estate agent fees, and so on. It could be costs to incur and sell the assets. So again, legal fees, estate agent fees. It might be any enhancement or improvement costs to the assets. So using the example of a house, if you put an extension on your house, you are quite clearly increasing the value. It could be an indexation allowance. We are allowed to deduct that too. Capital losses then. Most countries will keep capital losses separate from trading activities, simply because it's easier. So that being the case then, there's got to be some ways in which we can relieve a capital loss. So this could be done by either carrying forward against future capital gains, carrying back against previous capital gains. Perhaps we are going to offset against taxable trading profit in the current period.